Riverfront Investment Chairman Mike Jones says that the risk of a recession is fully priced into the markets and it's time to reinvest. In his latest note, Mike writes that emerging markets offer a powerful source of true economic growth. He joins us from Richmond, Virginia this morning. Mike, welcome to InBusiness. Emerging markets seem to be the safe place to park your cash. And then with this volatility in the markets, we saw Latin America sell off. It wasn't necessarily as clean of a trade. Why do you believe that it's still the best place to be putting your money?
Well, let's remember that the reason why we're selling off is that the market's starting to price in the odds of a recession in the U.S. and in Europe. And the only silver lining in that market sell-off has been that oil prices have come down fairly substantially. You're getting to the point where the emerging markets are going to start seeing food and energy prices coming down on a year-over-year basis. That gives them the policy flexibility to reverse what they've been doing for the last 12 months, which is fight inflation, and start fighting the slowing in the global economy by reducing interest rates and maybe even doing some fiscal stimulus, particularly in China.
So when you say emerging markets, you are primarily directing clients to invest in what, Hong Kong and Shanghai?
Yeah, I think that if you look at where the most dramatic increases in interest rates are, that's where you have the most dry powder for reversing policy and getting some stimulus going. So you need to look at the Asian economies where there has been substantial tightening in policy, but also Latin America. I think it's also important, though, that as we gauge our strategy, we still have about 20% cash in our major portfolios. Wow. The reason for that is right now we are clinging to about 1120 on the S&P. That's sort of the line in the sand between pricing in a mild recession and hitting a panic button over something more serious. We think the reason the market's been able to defend 1120 so successfully is people are replaying last summer's playbook, where they expect Ben Bernanke to once again step to the podium at Jackson Hole and give a great speech that promises more stimulus, and then we're off to the races. We are skeptical that that expectation is going to be met, because if you remember, last summer we priced in a recession and it never arrived. This time we probably have a lag between the slowing in Europe and the U.S. and the reacceleration in the emerging markets, and that's what creates that downside risk that we're still trying to manage with a cash position.
So it sounds like I want to wait until Friday to buy anything.
I think you might get a chance to do some more portfolio adjustments on Friday. Predicting the response of a single individual like Ben Bernanke is fraught with peril. I think the more important thing to keep in mind is last year's rally was a function of both monetary policy and real strong improvement in the economic statistics. We are really skeptical that those economic statistics occur, so you probably want to use it to keep managing risks until you see a policy change in either Europe or more likely a policy change in Latin America.
All right. Thank you very much, Mike. Good to get your perspective.
My pleasure.